Understanding 7-pay premium and 7-pay test before purchasing indexed universal life (IUL) insurance. TAMRA, Tax Reform Act of 1984, and the 7-pay test are crucial elements in determining how life insurance policies, such as indexed universal life (IUL), are structured in relation to IRS tax rules. Understanding these can help policyholders ensure they remain within IRS guidelines to avoid unintended tax consequences. 1. TAMRA, Tax Reform Act of 1984. TAMRA introduced important regulations aimed at preventing certain life insurance policies from being used primarily as investment vehicles rather than insurance products. Specifically, TAMRA targeted life insurance policies that were overfunded in an attempt to take advantage of tax-deferred cash value growth without triggering the full tax implications associated with investment income. What does TAMRA affect in IUL? TAMRA set limits on how much you could pay into a life insurance policy relative to its death benefit in a short period of time. If you exceed these limits, the policy could be classified as a modified endowment contract (MEC). To avoid MEC status, IUL policies, and other life insurance policies, are required to pass the 7-pay test. 2. 7-pay test. The 7-pay test is used to determine if a policy is a modified endowment contract (MEC) under TAMRA rules. Essentially, it ensures that the policy doesn't get overfunded in the first 7 years. How does the 7-pay test work? Under the 7-pay test, the sum of premiums paid into the policy over the first 7 years cannot exceed the total amount of premiums that would have been paid into the policy if it were structured to be fully paid up after 7 years, the 7-pay premium. In simpler terms, it limits how much money you can put into the policy in the early years, ensuring the policy isn't too heavily funded too quickly, which could convert it into a MEC. For an IUL, the 7-pay test ensures that the premiums paid over the first 7 years do not exceed a certain limit based on the death benefit. If the premiums exceed this limit, the policy will be classified as a MEC, losing some of its tax advantages. For example, withdrawals or loans taken from the policy would become taxable. What happens if the policy fails the 7-pay test? If a policy fails the 7-pay test, that is, premiums exceed the IRS limits, it will be considered a modified endowment contract (MEC). A MEC has tax disadvantages, such as taxable withdrawals. If you take a withdrawal or loan, it will be subject to income tax. Penalties. If you're under age 59 and a half, you may face an additional 10% penalty on withdrawals or loans. Why is the 7-pay test important in IUL? The 7-pay test helps ensure that IUL policies maintain their primary purpose as life insurance rather than being used as tax-advantaged investment vehicles. It allows the policyholder to fund the policy quickly, within 7 years, while avoiding classification as a MEC, which would result in a loss of favorable tax treatment. In summary, TAMRA set the stage for regulating how life insurance policies, including IULs, accumulate cash value without turning into investment vehicles. The 7-pay test limits how much can be paid into the policy over the first 7 years to avoid it being classified as a MEC, which would trigger undesirable tax consequences. By staying within these limits, IUL policyholders can enjoy tax-deferred growth of their cash value and potentially use the policy's cash value for loans or withdrawals with favorable tax treatment.